First of all, a big news. Anand Kerati channel has crossed 1,000 subscribers and I thank you for the support. This will keep me motivated for times to come. Let me start by asking you a question. How many of you would have liked to have Infosys when it actually got listed in the early 90s? I'm sure most of you would say yes. But now let me ask you another question. How many of you would have got the guts to hold on to it when the price went up 10x from the IPO price? What would you have done during the dot-com crisis when the price corrected significantly? And after COVID, when the price touched 1,000, how many of you didn't sell? This situation reminds me of a conversation that I had with a dear friend of mine. He said, Anand, I've invested 5 lakhs in cryptocurrency and I'm sure it's going to become 5 crores. I said, well, that's great. Good luck with that. Crypto has the ability to go up 100x, 1000x or to 0. But then tell me one thing, what would you do when this 5x becomes 10x? To which he didn't have an answer. One thing has become very clear to me now. People sell when the price goes high or when they see lower prices. As nutty as it may sound, please remember, this is an adaptation of the latest memo of my favorite investment guru, Howard Marks. Therefore, I request you to watch till the end for valuable investing lesson. Profit booking is an intelligent sounding term used by many in my industry. But for us to understand why we book profits, we first need to get insights into human behavior. After all, a lot of profit booking or selling is induced by psychology. In other words, we book profits so that we realize our gains and avoid a lot of unpleasant situations. Just imagine you bought a stock that went up 100%. You're very happy only to realize that after a quarter or 6 months or after a year, the profits have become lower and you're actually in losses today. Forget managing your own money. Just imagine the person like me. One quarter, you're talking highly about a mutual fund. And the next quarter, here you are explaining the reason why there's been a dip in NAV. Everyone, therefore, wants to book the profits and take home realized gains. There's a very famous saying that says that no one has ever gone broke booking profits. Absolutely right. But I think no one has ever gone rich or extremely rich booking profits. After all, you stop the power of compounding by doing so. I'm not saying you should not book profits or you should not gain out of overvalued assets. All I'm just trying to say is that selling just because that particular asset has gone up is no reason to sell, right? As wrong as it is to sell an asset to crystallize your profit, it's equally wrong to sell an asset just because the prices are coming down. But most of us always do this. Everyone knows that buy low, sell high is a great investment principle. But then we as human beings have the tendency of selling an asset as the price starts going down. So frenzied buying leads to bubbles and frenzied selling leads to declines. And bubbles and declines are a part of investment history and therefore proves that investors always behave in excesses in both the directions. Let me talk to you about a situation that really plays out. You buy a stock at 100 rupees. The price goes up to 120. You say, okay, I'm doing something great. Let me buy it at 120. The price shoots up to 150. You say, wow, I'm pretty sure the price is going to double up from here, only to realize that the price has come to 90. When it goes to 75, you say, oh, my thesis is very true. It's a big opportunity. Let me go and buy. You buy it or average out at 75 and later at 50, confirming that the theory is still okay. But then when the price goes to 20, you know what you would do? You would sell it all just to protect the remaining amount of capital. This is exactly that you would do. Just like the way we are scared of seeing our profit evaporate, we as investors are also scared of letting losses compound. I have enough evidences to prove that we as investors do this all the time. Let me take an example of average mutual fund return. Most of the investors make lower return than an average mutual fund also. Do you know why? Because they are always taking some kind of an action or the other. they start chasing returns and then they exit their underperforming mutual fund to buy an outperforming mutual fund, just to realize that the outperforming mutual fund that they invested recently has now started underperforming, while the underperforming mutual fund now has started outperforming. And this happens in cycle again and again and again, and there is enough proof to this. We all investors are trend following investors, but we shouldn't really be trend following investors. We should have this superior investing capability of making good the opportunity all the other investors give us. Just when you see a lot of investors are now selling, be the buyer, because that's a big opportunity for you to make substantial gains over a period of time. So you're not supposed to sell an asset when it is going up, and you're not supposed to sell an asset when it is going down. So now you as an investor may question me saying, Anand, when should I actually sell an asset? You know, investing is all about the discipline of relative choices. In other words, most of the portfolio decisions that you end up making are relative choices. In the sense, you have to evaluate a lot of other things before taking a call of selling a certain investment. There primarily can be two reasons why you can or you should sell your investment. The thesis with which you actually entered into a stock went wrong or is on the decline now, and therefore you may think that now is a good time for me to actually sell that asset. Go ahead, please do it. Or you see that, okay, there is another asset which is looking a lot more promising than the current investment, and therefore it is better for me to sell today only to buy those assets tomorrow. Or you can actually prune down or exit your investment. These two are the primary reasons for you to sell. It is easy to sell. It's just a click of a button and all the proceeds will come. The question that you need to ask yourself is, what are you going to do with the proceeds? If you don't have any other investing avenues, do you think cash as a position itself is great for you? And if not, then don't sell. I hope you found this video insightful, and I thank Howard Marks for his excellent memos over the last 40 years. Thank you.